Hello and good evening, everybody. Hi, Jeff. How are you doing?
Hey Benny, I'm good. Good to see you, mate.
Yeah, good to see you again after
Yeah,
2 months.
yeah.
Right. If you can hear us, can you just say yes on the comment so that we know that you are able to hear us? So the Singapore Exchange is back as usual, right?
Yeah,
After the Chinese New Year.
yeah. We had 2.5 sessions of holidays, and a lot had
Mm.
happened over those last 2.5 sessions as well. So we saw this catch up pretty much across Asia when we came online, firstly on Thursday, and then when Hong Kong came online on the Friday, then China came online yesterday.
All right. Yeah, actually tonight, tomorrow is a 9th day. Actually, it's a very big day for the Hokkien clan. It's going to be a big celebration for them. So we're probably going to hear a lot of fireworks here in Malaysia tonight at midnight.
Oh,
Okay, thank
brilliant.
you, Zin. Thank you, Doris. Thank you, Yo. Thank you for joining us, everyone, tonight. We have Geoff Howie from SGX, who's going to give us an update on the Singapore market. So how has it been doing since the past 2 months that I've talked to you? How has the market been performing?
Yeah, we've been pretty strong. In fact, we've been second best performing across the world, second to Brazil, would you believe? The STI has already logged up a 9% gain in the year to date
Mm,
versus the FTSE Asia Pacific Index, which has declined something like 2%. So it's had a very strong start to the year, but again, it's very much driven by its sectors, as we were saying last year. Underlying sector composition of indices matters so much these days when you have these growth drivers, inflation drivers being demand and supply
mm.
driven, as well as, of course, the ongoing developments with COVID-19 and Omicron. So we've been doing pretty good, Benny.
Right. We all know that the U.S. Federal Reserve probably going to taper off the quantitative easing. They're going to raise interest rates. But how is Singapore? Are they going to raise interest rates as well?
Well, we have, in a way, um, we so the MAS did actually change its monetary policy recently.
Mm,
It actually has done it twice. It did it at its October meeting, and then it again had a off-cycle change just recently in January. So, reason being is like the Fed Reserve, like much of the world, pretty much most of the world except for Japan, I think. There's these inflationary pressures. So last year in Singapore, CPI began in January with a 0.2% gain year on year, but it ended 2021 with a 4% year on year gain
wow.
in its CPI. Yeah. So what the MAS did, it raised the Singapore dollar nominal effective exchange rate policy slightly in January. Okay. And that off cycle tightening was attributed to the outlook for inflation.
Hmm.
And that was on recovery, also on the recovery of global demand and these persistent supply side frictions. So the Singapore dollar, the nominal effective exchange rate, if you will, between it's basically the exchange rate between the Singapore dollar and a basket of currencies with our big trading partners such as US, China, Malaysia, and so forth. In 2020, the World Bank estimate, for instance, for Singapore's GDP was $340 billion. But Enterprise Singapore also estimated our total merchandise trade came in just short of 1 trillion Singapore dollars. So the prominence of global trade in the small open economy, it means that this nominal effective exchange rate, policy band slope, the width, the center, they are the key policy tools to facilitate growth and contain core inflation from a monetary perspective, more so than the interest rates per se. So it's more of an exchange rate mechanism that we look at. So we've had that change in monetary policy recently.
Right.
Uh,
So, and of course, we've anticipated rising interest rates. There'll probably be more interest in banks. I think we have
yeah,
mentioned banks have been quite steady and in its growth over the past few years. So, other than interest rates, do you think that the banks will still have more catalysts to actually bring them forward, in the future?
Yeah, look, well, the interest rates have been a big thing to it. So, okay, I mean, just sort of looking at where we started, this 9% gain it's basically been a gradual development over the past 5 and a little bit weeks. So for the first month of the year was January. We had, what do we have? We had she don't remember. I think it was well, it was $1.8 billion of net institutional outflow for the STI stocks in 2021. Okay, and then for the first month of this year, the STI stocks saw around $800-900 million of net institutional inflow. And just for the first 3 sessions of the year of the Tiger, we've had another $500 million of net institutional inflow for the STI stocks. So it brings the net institutional inflow for the 30 stocks up to the close yesterday to 1.4 billion Sing dollars, just for that time. Now, what's interesting is the STI stocks that have seen net institutional inflows over the past 5 weeks, following outflows in 2021, they include quite a few. They include Singtel, Capital Land Integrated Commercial Trust, SGX, Keppel Corp, Wilmar, Singapore Airlines, Jardine Matheson Holdings, Gunting Singapore, Hong Kong Land Holdings, City Developments, UOL, and SATS. So that's also in addition to the DBS, OCBC, and UOB, averaging now 16% total return since the end of last year. We've combined net institutional inflows of $840 million in January and another $343 million just in the first 3 days of February. And then I'm not sure what it'll log up for today, but it'll probably be a little bit more when we look at it tomorrow morning when the numbers come through. But look, this is all because of the it's all because of this focus in the US on this, all of a sudden having to have an earlier withdrawal of accommodative monetary policy much quicker than we expected. Okay, and that's basically seen a lot. These expectations for the next FOMC on the 16th of March, they've become more hawkish. Some nights they become a little more dovish, but mostly have become more hawkish. And those expectations are, they're having a pretty high impact across the different sectors and stocks, because you think of it this way: the odds of a 50 basis point rate hike on the 16th of March were next to nothing at the end of last year. Next to nothing. They moved up from 16%, next to nothing, to 16% at the end of the January FOMC, and then up to 31% now, based on that strong employment report in the US, and that's for a 50 basis point hike. The remaining expectations are of a 25 basis point hike. So what's that done for the banks? The yield curve structurally shifted up 60 basis point last year. We talked about the yield curve quite a bit, and how we had a lot of yield curve steepening in the first half of the year, more to do in the first 3 to 4 months of last year. But the result of that was this upward structural shift of 60 basis points. Now, that's followed on with a 25 basis point structural upward shift in January, and then another 12 basis points in the first week or so of February. So that upward structural shift has seen banks among the strongest sectors across the world in the start of 2022. And of course, STI is 45% weighted to banks, hence STI's outperformance. If banks were the worst performing, the least performing sector for the last 7 weeks, we'd be among the least performing indices across the world. So it's as simple as that. But again, I should caveat: the banks don't make all, like you said, they don't make all their income from the banks. The impact of the interest rates is mostly through net interest margins. So banks have net interest income and they have non-interest income. The net interest income makes up around 50 to 60% of the total income of the trio, and then that net interest income can be increased by loan growth And as we saw, the three banks had increased their customer loans, two by 9%, one by 6% in the 12 months ending September last year, and their net interest margins had come off significantly since the end of 2019. They'd come off from the end of the fourth quarter of 2019 through to the third quarter of 2021. Net interest margins declined by 40 basis points for DBS, around 25 basis points for OCBC, and around 20 basis points for UOB. Hence, they have come off significantly, and they stand to increase with the increase and the upward structural shift in the yield curve and the normalization of interest rates. I should also mention what's driving it in terms of the inflationary pressures, because there's really three things. The big one is obviously the world's biggest ingredient in the whole energy mix of the world. It is oil, and Brent crude oil has continued to form these new highs. It traded a $94 a barrel high last night. WTI crude, I think, is around a bit above $93, around $93.20 a barrel, and then Brent crude at $94 a barrel. And along with the bank sector, the energy stocks have led the world across the world global stock market since the start of 2022. Secondly, there's been the supply chain constraints. The Freightos Baltic Container Index, that's continued to consolidate recently, and it is down 13% from its highs in September last year, but it remains 3 times higher than its end of 2020 level. That's the market rates for container shipping. And that's on the back of this multitude of supply chains we've got. And at the same time, you've got some of the big economies in the world, like the US, have seen increases in wages. Average hourly wages rose by close to 6% for the 12 months, for the past 12 months in the US. And therefore, much focus is on inflation in the US. The next number is due 9:30 p.m. Malaysia and Singapore time on Thursday night. That's the CPI report for January. But so this is what's basically been driving the banks. But what other key drivers are there for the banks? Other drivers, aside from the net interest income, the non-interest income, the ongoing digitalization of the industry is a key driver. The broadening of consumer and wealth management services, and of course this continued focus on supply chains, which are highly competitive for financing at the moment, obviously, and the growth markets, and obviously that ability to keep those allowances also very low. And also on Q, what we've seen here is UOB has proposed to acquire Citi's consumer business in Malaysia, Indonesia, Thailand, and Vietnam. I think that was mid-January, on the 14th of January that was announced. And then on Q, DBS also announced it was acquiring Citi's Taiwan business, consumer banking business in Taiwan, I should say. And that was announced on 28th of January. So there's plenty of dynamic drivers here. And in the next weeks ahead will be very important too, because the banks are then going to be reporting their full year 2021 results as well.
Right. So it looks like there's still quite a few catalysts that may support the banking growth this year as well, right?
Yeah, exactly. Yeah. So I mean, it's a familiar story to what we've been talking about last year. Bank stocks really led the net institutional flows into the Singapore stock market last year. They led the Singapore stock market last year, so they were a big part of the STI's 13% gain last year. But then not all of the sectors from last year have followed through this year.
Yeah. So you have mentioned earlier about tech stocks, because tech stocks has been leading the markets, especially in the US. But we did see some sell-off in the US tech stocks over the past 1 month. How has it been affecting the Singapore tech stocks?
Oh, certainly it has been affecting it. I mean, there's a few kind of, I don't know, a few reasons. I mean, if you take a step back and look what's been happening, it's pretty much since the end of 2020. From the end of 2020 right through to almost at the end of 2021, on the 27th of December, the Nasdaq index had gained 30%. That was a pretty strong move, all things considered. And since the 27th of December, so that's what, 6 weeks, it's actually generated a 13%, a 13% decline. So it was the 30% gain to its high at the back end of last year, and then since then it's declined 13%. And we've seen very mixed earnings seasons in the US as well. So since Amazon gained, its stock has rallied something like 10%. Since Meta missed its earnings, it's declined 30%. Multiple tech companies across the world and here at home as well, they've noted that key considerations are that supply chain factor that's figuring into the inflationary outlook as well. They've noted not just spiking energy costs, but supply chain bottlenecks creating rapidly rising costs for materials, shipping and labor, those key factors associated with global supply chains. And that weighs the outlook somewhat. But remember, the sector did perform very well last year, and that creates a high base, not just for the stock market, but obviously for economic outlooks as well, for the various subsegments of manufacturing. AEM and Franken Group, they both generated total returns just over 50% last year, and they've so far averaged 12% declines this year. UMS and ISDN, they both generated 80% returns last year, and they've averaged 12% declines so far this year. A little bit different, though, in terms of returns. I think ISDN has been comparatively defensive with a 4% decline, where UMS has declined something like 20%, I think, close to it. Grand Venture Technology, it's declined 13% so far this year. And remember, that was the stock that graduated from the Catalyst board to the main board with a 260% gain last year. So we've had some repricing and some measured moves. But as expected as well, the social and the economic constraints of the past 2 years, it had significantly notched up momentum in cloud, 5G, and data services. So our outlook, for instance, Benny, we might be talking about eventually me coming to KL and catching up with you, and maybe we can have a real in-person event.
Yeah.
So, but this still works. But I guess it's up to the investors to really decide at what point will we be doing this in person and doing away with some of this, the cloud and the data center requirements that we've had amid these challenges. But nonetheless, look, demand for semiconductors is still expected to grow at that 10% compound annual growth rate. Keppel DC REIT also did note 2 weeks ago when it reported that globally increased investments in digital infrastructure have continued. And of course, the adoption, the access to technologies rate also bodes well for the digital economy. So there's plenty of factors that are going into consideration. But I think the biggest driver this time has been that costs associated with supply chains. And if you look at that Freightos Baltic Index as a type of a benchmark for supply chain, or an ECG for supply chain pressures, while it is off, as we said, that September high, it's still something like 3 times higher than it was at the end of 2020.
Mm-hmm. Yeah. So do you think that the recent pullback in the U.S. markets is just a knee-jerk reaction because of the expectations of the rising interest rates? Because the earnings are still not that bad. It's just, I think market is forward-looking, right? And you say because the prices are, if you compare with the prices, that has gone up from the high base and it's pulled back 13% after going up 30%.
Yeah, but it's all a part of its structure. The technology sector has been a massive part of the almost doubling of global market capitalization over the 5-year period, as we've discussed before. And what this current juncture for an economic outlook, it's providing headwinds for certain sectors, especially tech. Whether it's seen enough headwinds and so forth, I don't know the answer to that, obviously, and I'm not. That's not my role either. I'm here just to educate on the facts that's brought us to here. But it is quite interesting because there's also sectors that have ridden tailwinds, as we said, the banks and the energy stocks. Geo Energy Resources, Rex International, RH Petrogas. They're among a select group of stocks we've got that are involved in the exploration and production of energy resources. They averaged 9% gains in January, and the gains just over the past 4 sessions have taken their average year-to-date gains to 25%, and that's quite symmetric across the 4 stocks, averaging between 20 and 30% gain. Meanwhile, also on the energy front, Sembcorp Industries, that has pressed on with its strategic transformation of its portfolio from brown assets to green assets. It's generated a 14% total return in January, and then another 8% gain over the past 4 sessions. So it's also generated a return so far over the past 5 weeks of around 23%, also in the 20s. So Sembcorp Industries, Geo Energy Resources, Rex International, they're among our 20 listed stocks that saw the highest net insti buying in January. RH Petrogas ranked just outside the top 30, I think it was. And of course, Rex International, like Grand Venture Technology last year, is also looking to graduate from the Catalyst board to the main board. So, it's interesting. The market per se, I remember coming into this 25 years ago, and you think, one big event, such as one big hedge fund going bust, or one country or a couple of countries having a few current account difficulties, could create a big distortion across the global markets. Remember that contagion effect? Yeah. But these days, I think investors have become moves are a little bit more fragmented. Investors are a little bit more precise, and the current drivers of both the economic challenges ahead and the economic opportunities are varied over the different segments. So you have a number of sectors that have been facing a lot of headwinds, increasingly so over the last 5 weeks or so, and then some that have basically seen more tailwinds and being able to ride it. So as we said, bank and energy stocks have been among the world's strongest. Omicron also still has a massive impact on a global basis. We made that peak around 3 million cases a day in January, and that's come off over the last 2 weeks. So we're down to around 2 million a day now on a smooth basis. So it looks like the world's past its peak of Omicron, and hence we're seeing just more recently some of those sectors that were laggard, particularly at the back end of last year, right at the end of last year and earlier this year, start to creep back up. Airlines, lodging stocks, and so forth have sort of been performing better over the past couple of weeks on the Omicron developments. So yeah. So what's happening in the US? You've got to take a lens to exactly what sector and what segment.
Yeah, I was quite surprised as well, because I think Genting Malaysia actually jumped about 8% today in Malaysia. Despite the Omicron, which is actually rising right now, we are having like 13,000 cases a day. I think we are facing this Omicron wave. For Malaysia, it's probably just starting. The world is actually tapering off. But we do see some surprises. I think, the pandemic or the COVID-19 is probably going to be endemic soon. When our health ministers say that you don't even need to go and report with the authorities when you get the first and second category of COVID. That shows that, I think it doesn't really bother us that much anymore. It's becoming more like a flu.
You're right. I mean, yeah. I know at least 10 people who have caught Omicron in terms of friends and family. Just about, probably closer to 20. It's been very prevalent. Thankfully, no one's has had to be hospitalized. So it's touch wood. We're kind of in a good place. That we knew it would be. Remember, we said in November that it would take a month or so to work out the vaccine efficacy, how transmissible it was, and how severe it would be. And thankfully, it hasn't been as severe as Delta. Less severe Delta, much more transmissible though. And obviously, it's really important to get those shots as well. The US has seen its mortality rate pretty much pick up quite a bit, and it was a little bit of a concern, particularly over the last 2 weeks as it was going into the peak. 2 weeks ago, because the issue is, I think 75% of US citizens have had the first shot, but only 64% have had a second shot. So it's it's we still got works to do. We've still got to make sure we continue our global vaccine campaigns. But thankfully, we're able to work. One of my colleagues, he had the Omicron, and he was back to work within a week. Which was great. So, like you say, it's an endemic. Now very much in that endemic stage, and we have to learn to live with it, and keep moving forward.
Yeah. Hopefully we'll have our borders open soon so that either I can travel over to Singapore, you can come down and we can really meet up face to face.
Yeah, exactly. And things are still happening in Malaysia. I saw that you had a stellar employment report today as well. Very strong. So yeah, I'm sure it's going to happen very soon.
All right. So talking about that,
there's actually a restaurant across the border in Johor Bahru that I really like, and actually rang them the other day, and yeah, they're still there. So getting ready.
Yeah, I think the good thing is that those good restaurants will still be around because they still have customers during the lockdowns, right?
Yeah, exactly.
Yeah,
exactly.
great.
But
hopefully you can have your favorite food soon. So other than the tax and the energy sector, are there any surprises, because we are into the earnings seasons right now, right? Are there any surprises in earnings?
Yeah, there's been one standout, I guess. That was Keppel Corporation. So, so when did it report? It reported after the 27th of January close. Now, on the 27th of January, the stock closed at $5.29. It reported its full year numbers after the close on 27th January. It's now 14% higher at $6.01. So what it reported for its full year 21 results ending 31st of December, its net profit surged to, I think it was 1.02 billion Sing dollars, and that's the highest level it's been in the past 6 years. And it meant that net profit basically crossed that 1 billion threshold for the first time since FY15. And it was also a pretty sharp turnaround from its net loss in FY20 of $506 million. So the ongoing transformation, it was cited to the group's return on equity. Actually, I should also note that ROE, return on equity metrics, seeing them touted more and more here in Singapore going into the earnings season as well as a key. It's always obviously a key financial metric, but in terms of those two acquisitions that the banks made, UOB and DBS, on the city consumer businesses across the region, they highlighted the impact it would have on ROE, and then of course Keppel Corp as well. It used the ongoing transformation that it's doing as the reason for its ROE turnaround to 9.1% from negative 4.6% a year ago. And under its Vision 2030 transformation plan, it actually has a long-term 15% ROE target. So the group also proposed a $500 million share buyback program, and that has so far seen them buy back only 0.2% of their shares, but that's still significant over maybe a week or two. They led the tally the week before for buybacks in Singapore. Shares that they repurchased that will be held as treasury shares, as they typically are, and used for the annual vesting of employees' share plans and so forth, which is a popular reason for conducting share buybacks. But it's also, they said, it would be used as possible currency for future merger and acquisitions. And the pursuit of strategic merger and acquisitions to accelerate these growth engines that it has identified to be part of this 2030 initiative is quite important going forward. It aims to refocus the portfolio to be this integrated business that I think we've talked about before, this end-to-end solutions for sustainable urbanisation. So you've got the focus on the energy, you've got the focus on environment, urban development, and asset management. I think they throw connectivity in there as well, which is obviously important to many businesses. But in the Q&A session that followed, the company reiterated it was exploring M&A opportunities or in growth engines such as data center platforms, not just in Asia, but in Europe and the US, in addition to asset management platforms for bolt-on acquisitions. And I guess in the environmental and the engineering space, and the infrastructure side, it was also looking for opportunities as well. So that was a surprise. As I said, the stocks rallied 14% since, but the immediate day after it reported those FY numbers, the stock had rallied 6%, and also seen significant turnover in the course of the day.
Right. Wow. That was really unexpected, right?
Yeah, but we still got a long way to go. We still got quite a few companies to report. See, a lot of the reporting for this earnings season is for full year financials. It might be up to around 2/3 of the companies have their end of year at the end of December. So we've still got quite a lot ahead.
Right. So, any stocks that you have seen significant increases in its turnover that has performed good or bad over the past 5.5 weeks?
Yeah. So as we said, energy stocks are up significantly. Rex International, comparing, I guess, a turnover tally or a turnover leaderboard compared to last year. DBS obviously number one. Rex International is up 10 places in turnover. RH Petrogas is up close to 50 places in its turnover ranking. Interesting, UOL Group, which is an STI stock, is up 10 places in its turnover. Its share price is up around 5% over the past 5 weeks. And UOL maintains an extensive portfolio of residential projects, investment properties, hotel, hospitality, service suites, and so forth. It's seen $8 million of net insta inflow so far this year. And that's after last year generating a 6% decline in total return and also seeing $30 million of net insta outflows. Ascendis India Trust is also up 14 places in turnover, but it's declined 8% so far this year after a 2% gain last year. The interesting one, Straits Trading, it's up 40 places in turnover. So it's now among our top 80 stocks by turnover. But it's also recently issued placement shares, which represented around 6% of the total issued shares of Straits Trading, the Straits Trading company. And that increased the free float of Straits Trading from 25% to almost 30%. And that was expected to obviously provide a corresponding increase in trading liquidity. And it has. I mean, the company, the Straits Trading Company, it's a conglomerate investment company, operations and financial interests in the resources, property, hospitality, and of course a Bursa-listed company. It as well. It has interest in it, and I think it's declined something like 3% this year in somewhat of a measured move.
So, do you have any idea on which stocks that have moved down the ladder?
Yeah, I do. I can have a look. And actually, I do. But I don't really focus on them. I'm always focusing more on what's moving up. But I do have it here. Yeah, I do have it here.
Yeah.
Who's gone down? Sorry, I'm looking at my ceiling. Yeah, City Developments and Suntech have gone down 4 points. A big stock, SBH. Well, that makes sense. SBH is currently in its final steps of being privatized, going off the market. So so that makes sense. But yeah, not many. Interesting. Not many big declines. Sembcorp Marine has come off quite a bit. Sheng Xiong Group has come off quite a bit. So yeah, but not as many. I mean, you have stocks that generally move up the ladder quicker than stocks actually come off, which makes sense.
All right. Okay. Thanks. Okay. What about China. What about China stocks in Singapore? How have they been performing?
Yeah, it's in line. The FTSE ST China index we have, it's close to 20 stocks, around 20 stocks that either have 50% of their revenue reported to mainland China or base more than 50% of their assets in mainland China. And the index has gained 6% so far this year versus the H-share index, which is up 3%. It does not include catalyst stocks. So our most traded basic material stock, which is catalyst listed Zhejiang Chemical, that has actually rallied 16% over the past 5 weeks on $6 million for net institutional inflow. And basic material, raw material stocks, they've performed okay. They haven't been one of the laggard industries. They haven't been one of the leading industries, but they've been sort of in the middle there. Now, of those FTSE ST China stocks, the moves have been a little bit varied. Jardine Matheson Holdings in there. That's up around 11% so far in the year to date. Since it announced its share buyback program, since it made its first announcement to its share buyback program for the initial 250 million before it doubled it to 500 US million, when it made its first initial announcement, that was on the morning of the 30th of September, and the stock has rallied close to 20% since then, and that's led the performance of the FTSE ST China index. Hutch Port's in there, that's up 7%. Wilmar's in there, that's up 6%. Yan Lord Land is up around 5%. On the other side, Nanofilm Technologies is down 22%, and that's in that index as well, and that's leading the laggards. So quite a few mixed performances, again, sector related, very much related to sector trends.
All right. Okay. We know that the property sector has taken a hit during the pandemic, during the lockdown. So how has the REITs been performing? Do you see a comeback?
Yeah, it's globally, REITs have been underperforming just like technology stocks. So globally, it's been banks and energy leading, and for most of the time, it's been REITs and technology being the least performing. And of course, as that 10-year bond rate goes up from 1.5% at the end of last year to 1.77% at the end of January to 1.9% right at the moment, that is seeing a little bit of compression in the premium that REIT yields hold over US 10-year bonds. So making it a little bit less of a case for investing in REITs. And that's basically raised the REITs with the outlook for borrowing costs weighed a little bit by the higher interest rates. I guess, look at it this way. If you look at REITs and tech stocks in Singapore, we saw as many as 12 stocks from those two sectors rank among the 15 Singapore-listed stocks that saw the highest net institutional selling in January. No big surprises in the S-REIT earnings, though. However, what was interesting was last week, CapitaLand Integrated Commercial Trust, it led the SDI stocks over the very abbreviated week. So we only had 2.5 sessions of trading last week. But nonetheless, sorry, I don't know why. I should turn my computer off all these funny little sounds. I'm hard enough to follow as it is, right? So CapitaLand Integrated Commercial Trust, it was up 7% over those 2.5 sessions. And it meant also for that week, this REIT, which is a diversified S-REIT, was among the top 5 performing global REITs with a market value of more than $1 billion US dollars. So going back to when they reported a couple of weeks ago, when the CEO of the manager reported, he reiterated he was cautiously optimistic for 2022 for 3 key reasons. The first was the portfolio valuation at the end of last year. It was 3.5% higher year on year. And that's, obviously signifying this improving outlook for retail and office properties here in Singapore. Secondly, for its portfolio, the operating metrics had remained resilient after all the challenges of 2021. And then thirdly, it had its properties such as the Collier Quay, the Six Battery Road, and the CBD had undergone upgrading works in the last 2 years. And then there's the newly completed development project Capita Spring as well. And then it has also had the 3 assets in in Sydney, excuse me. And that will help to contribute to income in the second half of the year. So, like we said, while you have the challenges, you have to obviously, look for other ways to improve unit holder value, and within the active portfolio management has seen has seen the CEO cite these factors as some pretty big drivers for their outlook for the remaining of the year. I should also note that our Business Times reported last week that after bottoming out last year, office rents in the central region are expected to improve further this year. Tight supply, improving economy, the usual attributes. And also on the 4th of February, on Friday at 1 p.m, SingStat also reported our final retail sales print for 2021. Retail sales were up 7% in December year on year, after a 2% increase, I think it was in November, and it brings the 2021 total increase in retail sales up to 11% from 2020.
Right.
And like sales of restaurants also in December, I should mention, they increased 20% year on year, which was due to the easing of the dine-in restrictions that we had.
Mm-hmm. Okay, interesting. So, guys,
actually, it was month on month. It wasn't year on year. Sorry, Benny.
Month on month.
Yeah, it was month on month because we had some restrictions in November, and then they released in December, so it was good.
All right. Okay. So it's like back to normal now. Do you still have restrictions on going to the malls and restaurants in Singapore?
But it is back to normal. But I think we're all used to using the check-ins, and having the masks, obviously, and still keeping space in restaurants and so forth. And I think I remember in an interview in February 2020, and we were all talking, we'll all have to do this together, we'll really have to, everyone's going to really have to come together to get through this, and it's been a blessing to be in this country over these 2 years, the way the community has really all come together, and we've gotten through,
Oh, that's great. I know the indication of people going out in Kuala Lumpur at least it's crazy. It's the traffic is back to normal. I miss those days actually when there was a lockdown. going anywhere is actually a breeze. But now the traffic is back.
And we were all back, so we're all pretty much back to the office too. I mean, I'll be working from home when I have events, presentations, or media interviews. But there's certainly, the CBD is very, very busy these days. We're right next to Lau Pa Sat, the SGX office. So, when I leave when I walk out at 6:30, 7 o'clock, all the satay barbecues are in full.
Right. Well, I really wish all the best for the retail sector. Hopefully, they are able to recover this year, because they have been suffering actually for the past 2 years, right?
Yeah, exactly. I've lost a couple of my favorite coffee shops over the last 2 years, which is really it's been really tough for them. But it's not over yet. Still, it's still somewhat of an uneven recovery. Construction, retail, and so forth, transportation services. We've still a little ways to go, as most countries do globally, obviously. But we touch wood that the world continues to go past this Omicron peak.
Yeah.
and
Well,
that if
guys, if you
any,
have
yeah, sorry.
sorry. Yeah, sorry. If those who are watching, you have any questions for Geoff, you can type those questions in right now. We'll probably have another 10 more minutes with him. So please do, ask those questions. And if you're interested to find out more about REITs and to go an in-depth analysis on REITs, you can actually go to a website that we have actually created, and it's free. It's sgx.equitiestracker.com. You can actually get a lot of details on the REITs in Singapore, Singapore REITs, right, up to the property, the whole the property that they have in different locations, and all the other details that you need. It's all there. So just go to sgx.equitiestracker.com. All right. Yeah. So you have any questions? You can type in right now. I probably have one more question right now for Geoff. What about ETF, Geoff? Which are the ETFs that has been?
Okay, so last year we celebrated 20 years of our ETFs, so it was a watershed year. The combined AUM finished the year at 12.5 billion Sing dollars. That's up close to 40% from $8.5 billion at the end of 2020. 22 of the ETFs recorded AUM growth. We had 5 debutantes as well. The ETFs last year that really performed were the Vietnam. Vietnam was Asia's, I think, if I remember right, Asia Pacific's strongest market last year. So that ETF performed very well. I guess appetite for the yields also extended to 4 of the 5 SGX listed ETFs that track REIT indices in terms of inflows last year, capital inflows into the ETFs. You kind of, what's been happening is the surge of inflows. It hasn't so much been to the equity ETFs. It's been more to the Asia fixed income products, particularly Asia high yield bonds and China government renminbi bonds. They had respective yields of, so the Asia high yield bond, I think, was 4% at the end of last year. The China government renminbi was 2.8% at the end of last year. So that actually attracted quite a lot of inflows and was a big driver in the increase in AUM. But we've also, I should say, made some microstructure changes just 3 weeks ago. So 17th of January, the board lot size for all the ETFs was reduced to 1 unit. And that helps to make the whole dollar cost averaging process that many investors choose to use and adopt with ETF trading more efficient, with the flexibility that it offers. And then you've also got greater price flexibility in the placing of limit and buy orders, limit buy and limit sell orders now as well. So too early to tell what impact it's had on trading, but nonetheless, it's quite a little vibrant part of the market for us. But that's more for passive investors than the active traders. But some products do move significantly, particularly the China-related ETFs, and maybe the STI too, if it's 9% gain so far this year. But what we've seen is, for the retail investors, quite a bit of profit taking on the STI ETFs, because the STI ETFs really saw their AUM grow significantly in 2020 amidst those market lows. So hence, at these higher levels, we've continued to see more sell orders than buy orders into those STI ETFs.
Right. Well, thanks, Geoff. We do have some questions from our viewers. First, we have Karina. She's asking, so do you expect REIT prices to be pressed down due to the expectations of rising interest rates?
Yeah, well, the thing is, those expectations have really been at the forefront of market moves over the last 5 weeks. And it's interesting in that there's still a long way to go before the 16th of March. And there was one instance mid last week when the REITs recovered very well, tech stocks as well, when the interest rate expectations turned a lot less hawkish. because there was some growth concerns in the US. Going into midweek last week, the expectations for the US payrolls actually came off a lot because the private sector, there was an ADP number that was really weak. And I think REITs rallied around 1 to 2%, 2% in the follow-up session across the world. So the thing is, REIT prices can go up, can go down on the back of interest rate expectations on a day-to-day basis. If you want to keep an eye on it, it's pretty easy to do in terms of the expectation gauge. There's the CME Fed Watch tool. You can just Google CME Fed Watch tool, and that will give you what the expectations are currently for the 16th of March FOMC. What's in 6 weeks or so. So that can be useful, Karina, because that can change, as we said, on a week-to-week basis. The expectations for a 50 basis point rate hike dropped quite a bit that midweek when we saw the broad-based rally in the middle of the week. I think Wednesday, Thursday thereabouts. So yeah, you'll get to see that, I guess, on a shorter term basis, week to week, day to day. But again, right. There's it's not all interest rates. The REIT yield is still significantly higher than the US yields. US Treasury yields have come a long way. They've come from 1.5% in the end of last year to 1.9% now. But global REIT yields are still above 4%. So they still maintain a decent premium. For the Singapore REITs, our average yields are around 6.5%, even higher. So there's still quite a big important buffer. But nonetheless, as we see these days, what happens to global REITs can impact local REITs.
Mm-hmm. In fact, Karina, if you can join us on the 22nd of February, we actually have a research piece on this webinar on the 22nd. It's called Taper Tantrums. When the yields have started to get crazy, start to go up quite aggressively because of the expectation, right? And we saw this happen in 2013 when the Fed at that time was saying that they're going to also ease quantitative easing. But that did not happen, right? And markets keep on making new highs. So right now, of course, we will be looking at the data and so on, and of course March 16 as well, the date for FOMC. So join us on the 22nd of February so that we can give you the data in more details as we go on. All right. Okay, thanks, Geoff. We have one more question here from Lau. He's asking, what's your take on gold in particular gold, GLD?
Yeah, it's been pretty quiet. Obviously it had a lot of attention and a lot of turnover amidst the volatility of the second quarter of 2020. But since then, it's just been notching up slowly higher. It's still seen as a long-term tool for hedging. It's the least correlated asset to anything, and I guess the fact that it has been not so volatile just reiterates that fact. It is not a very correlated asset, and the World Gold Council suggests you should have 1% to almost up to 10% of a portfolio with gold in it to help basically reduce some of the risk that can come with having too much of a concentration across one or two asset classes. So that's the talk their book, and of course that they will maintain that, and we respect them for that. But it's up to but basically at the end of the day, up to you as an investor how you would want to really structure your portfolio. But really, that's a portfolio diversifier. Is its major role when it comes to the ETF and most of the investor applications to it. The size of gold in terms of the overall AUM of our ETF market has gradually come off over the last couple of years, obviously, as we've introduced new products and new choices to investors, which include more fixed income, more money markets, and so forth. Yeah, so there you are, Benny.
Thanks, Geoff. Sorry, I think my camera just caught up. I got no idea why, so I'm using another camera right now. Yeah, thank you, Geoff. So if looks like there's no other questions. Yeah. All right, so I think we have covered almost a lot of things tonight. It's been 1 hour. Thank you so much, Geoff, for your insights. It's been a pleasure talking to you again. We do
Thank
hope
you.
to see you again in our next session.
Yeah, I really look forward to it. Just for the rest of the week, just keep an eye out. As we said, that Thursday night, 9:30 p.m. US CPI. Singtel should also provide a business update for its third quarter this week, and then in the coming weeks, you have the banks as well. I think DBS, if you can remember this, Monday, the Feb 4th, next Monday before the open, DBS will report. UOB the Wednesday before the open, that's the 16th of Feb. And then OCBC on the 23rd of Feb, the week later. Okay, so just if you can remember that, and we've also got our budget on the 18th of February next Friday to one to watch as well. More focus on recovery and building this further resilient. We had a really strong economic rebound last year, up 7% GDP. But the recovery, as we said, still continues to be uneven, hence why the overall revenue is expected to be higher. Expenditure and support measures are cutting into that revenue growth. So that's one to watch as well.
Right.
So thanks very much for your time. Thank you.
Yeah, thank you so much. And guys, if you want to have updates on the SGX, what's happening in the SGX, please do join their Telegram group. All you need to do is search for SGX Invest in your Telegram. And Geoff actually has a lot of contents there as well. So please do search for SGX Invest in your Telegram, right? Okay, once again, thanks a lot, Geoff. Wish you all the best, and we'll see you again in the next session. And
Thanks.
for those who join us, thank you so much, and have a good evening.
Good night. Thank you so much.